Hello, and welcome to What's It Worth? Understanding the Value of Your Child Care Business. My name is Jenny Masal, and I am a business consultant with the ICA Group. The ICA Group is a national nonprofit organization with a mission of changing the nature of work by advancing businesses and institutions that center worker voice, grow worker wealth, and build worker power. We have a team focused on childcare industry. We work with childcare business owners across the country, really focused on the business side of running a childcare business. And our work in childcare comes from the understanding that many childcare businesses are financially insecure and unable to pay living wages to the owners and the workers. So we offer business consulting, access to capital, succession planning, and cooperative ownership models to build a better childcare industry. This webinar is on the technical aspects of how business valuations are conducted, and it's based off of a guide on our website called What's It Worth? Understanding and Increasing the Value of Your Childcare Business. It's part 2 of a 3-part webinar series. The first part was on Business Valuation 101, so a high-level overview, and part 3 is on factors impacting your business value. So visit our website for those other webinars as well as the guide, icagroup.org/childcare. A valuation is the process used to estimate the value of a business's assets or equity. It tells you the fair market value of the business and why the fair market value is what it is. The fair market value is defined as the price at which the business would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or to sell, and both having reasonable knowledge of relevant facts. There are multiple approaches to conducting a valuation, but all approaches assume that an individual invests in or purchases a business to generate wealth. And so a buyer will consider how much profit the business has generated historically and its ability to generate profits in the future. I'm going to be talking about 3 primary valuation methods: market-based valuations, income-based valuations, and asset-based valuations. And so a market-based valuation analyzes the value of similar childcare businesses to determine what others in the market are willing to pay. So you might look at childcare businesses of a similar size to yours or in a similar geography to yours. And this method often uses a multiple of earnings. So you multiply the company's earnings by an amount in proportion to similar firms to arrive at an estimated value. So this method is really simple, but it can be challenging to find useful market data, especially for small companies like childcare centers. And so one rule of thumb for small businesses like childcare centers is that the business value is equal to 2 to 3 times the EBITDA. And EBITDA stands for earnings from audited financials before interest expense for outstanding loans, taxes, depreciation of assets, and amortization of intangible assets. So if your EBITDA was $100,000 for the year, the business value would multiply 100,000 by 2 to 3 and get an estimated business value of $200,000 to $300,000 using this method. And so this chart shows the EBITDA for a child care center between 2014 and 2017. In 2016, the center had a high EBITDA of $196,000. In 2017, the EBITDA dropped to $130,000. And then the chart shows what happens when you multiply that EBITDA by a range of 2 to 3. So for each year of EBITDA, multiplying by 2, multiplying by 2.5, multiplying by 3 to get a range of values. And when we look at all those values for the EBITDA between 2014 and 2017, multiplied by a range of 2 to 3, we get a median value of $396,000 and an average value of $406,875. And so this approach really highlights the range of values that can exist based on your EBITDA as well as the multiple. Another rule of thumb is that a child care center is worth $2,000 to $3,000 for every licensed child. So a center with a licensed capacity of 100 children would be worth between $200,000 and $300,000, which is what's calculated when you take 100 and multiply it by $2,000 to $3,000. And a final rule of thumb is that a child care center is worth 2 to 3 times the owner's cash flow. So for a center where the owner takes home $90,000 each year in profits, that center would have an estimated value of $180,000 to $270,000, because that's the result of multiplying $90,000 by the range of 2 to 3. Moving on to income-based valuations, there are 2 types of income-based valuations, and both are based on determining how much cash a company can produce in the future. So this method is used when a company's earnings capacity contributes significantly to the value of the company, when the company has positive earnings, and when expected performance and growth is predictable. And so the capitalization of cash flow method looks at the value of current cash flows. The discounted cash flow method looks at the value of projected future cash flows. And so the discounted future cash flow method would involve using the company's financial statements to forecast financial performance for a forecasting period. And forecasting period is based on the length of time it takes for the business to reach maturity or steady revenues or profit. And then you use these projections to determine the cash flows or income that a buyer can expect from the business, and you discount that to a present value. So this approach is really centered around understanding how much cash can the company produce in the future and what is the present value of that cash. And finally, asset-based valuations assume the company's value is equal to the underlying value of the company's net assets, which is also called the book value. So total assets minus total liabilities equals book value, or basically the book value is calculated by taking what the company owns and subtracting what the company owes. And in childcare, most of the childcare center's assets are what we consider intangible assets. So these are things like relationships with families, and these translate into profits on the income statement. The center does also have tangible assets such as furniture and equipment, and these have value regardless of the business's financial performance, but usually are not significantly high in value compared to, say, a manufacturing company that owns millions of dollars of equipment. And so it would be less common to use an asset-based valuation to value a child care center, but they are used when a company owns assets of significant value or if the company does not have an established or positive earnings history. So a company that has not been profitable historically, an income valuation might produce a value of 0 for the business. So an asset-based valuation would be used to value the assets of the business and structure a sale around that value. And the market value of invested capital, or MVIC, refers to the total compensation that's paid to the seller and includes any cash, notes, or securities that are used as a form of payment for the business. And so the structure of the transaction influences the total MVIC. So if you sell your business to someone who pays 100% of the selling price in cash, that cash amount is what your total MVIC is. But most sales of business include seller financing, which means the buyer pays the seller over time for the business. And in that case, the buyer and the seller negotiate whether there's any interest payments on those payments. And so the MVIC would equal the cash payments as well as those interest payments that the seller would receive from the buyer. And so if you consider a center with $100,000 in EBITDA that has a value of $200,000, if you're selling that center and one buyer offers you $150,000 in cash, and a second buyer offers you $50,000 in cash, and then another $150,000 over the next 3 years out of the center's profits, which is a better deal for you? So with buyer one, you would receive $150,000 all at once. With the second buyer, you would receive approximately $220,000 as cash payments and interest payments. So that second option directs more money to you, but it also has more risk because $150,000 of that is based off of the assumption that the center will have profits to pay you with over the next 3 years. And so if buyer two bought your business and it wasn't profitable, you would not receive that payment. So buyer one directs kind of more money up front. It's a lower amount of money, but less risk, while the second option has more money going towards you, but also more risks. So these are all things that are important to think about in addition to the value of your business, is how are you structuring the transaction and what does that mean for the amount of money you're receiving for your business? So this webinar was really a detailed summary of how valuations are conducted. Again, it's part 2 of a 3-part series. So part 1 is on Valuation 101, and part 3 really focuses on ways to increase the value of your business. So definitely check those out on our website. And then also feel free to be in touch with us to see if you qualify for grant-funded succession planning services. At ICA, we recognize that as owners of a child care center, you've put your heart and soul into your business and providing quality care for your community. And while we know it can be hard, planning for your eventual exit from the business is one of the best things you can do to preserve the value of your business, ensure your legacy, and achieve the retirement goals you desire. So after working with us and our exit planning team, you'll receive a summary report including a business health check and cost of care analysis, enterprise valuation, an analysis of your business value drivers and tips to maximize value, and a summary of paths to exit the business. So once again, feel free to contact us to see if you qualify for grant-funded succession planning services. Reach out to Ann McSweeney, our Child Care Program Director. Thank you so much for attending this webinar, and please check out the other child care business resources on our website. Thanks so much. Bye.